Good morning. You're watching the market right here on ET now. The US Federal Reserve has hiked the policy rates along expected lines another 25 basis points last night, but acknowledged that the recent banking crisis and expressed caution, indicating that the hikes are nearing an end. In fact, the dot plot now forecasts just one more rate hike in 2023, the calendar year. The Fed did not sound as hawkish as earlier. In fact, I would say it was a dovish commentary, but added that rate cuts are not in their base case for the remainder of the year. Along with its ninth hike since March 2022, the rate-setting Federal Open Market Committee noted that future increases are not assured and will depend largely on incoming data. As dovish as the Fed could be in this current market scenario, I guess.
Yeah, so why have they considered a rate hike when we are also talking about a crisis in the US financial sector? Well, I think the messaging is very simple, that the tools to fight inflation are separate and the US financial system can digest a 25 bips rate hike. So I look at the optimistic bullish part here, and the bullish part here is that in terms of signaling, the Fed remains absolutely clear and certain in terms of the messaging that the US financial system can digest this rate hike. That's one. B, markets meanwhile, well, you can argue back and say that in the near term, if interest rates are nearing their peak, then why markets, and why is that we've not seen a big flare up in equities, high growth stocks, emerging markets? That's largely because Fed has also indicated that in the near term, the mess in US financial sector will lead to a contraction in growth. So you're dealing with a patch where inflation is high and growth will be hunkered down, and that could lead to some change in estimates. So the setting on the table is the Fed event has come and gone. It's more like a no event, nothing new, nothing disturbing, and more an endorsement of the obvious that the Fed will use the tools in order to stem this entire US banking crisis, so to speak. So it's turning out to be no event on expected lines, no new tone in terms of messaging, and when everything is on expected lines and when there is no surprise, markets would say it's time to move on. Let's argue about it.
Yeah, absolutely. Having said that, one would have expected a little bit of a, better reaction, if you will, from US equity markets. And that's really not the case, because if you just look at how overnight Wall Street actually performed after the Fed comments, it was a 530-point cut, no less, for the Dow. The S&P as well managed to eke out a 1.6% loss and almost a 200-point fall for the Nasdaq as well. Growth stocks and defensive stocks, they were the ones which outperformed, whereas value, cyclicals, bond yields, they were the ones which declined, and the dollar index per se turned a little bit soft.
Yeah, so ultimately you have to look at what it means for India, and let's look at the setting on the table for Indian markets. Where does India stand? And if Fed is indicating that it's going to be a soft landing for India, it's actually not a bad outcome, so to speak, for equity markets. What is important in the near term when you are gauging the market reaction, you have to look at what has been the template. Foreign institutional investors have been net sellers, and the net short is at about 90%. So in the run-up to the event, FI positioning was extremely bearish. Nifty has found support at a key technical level. The event risk is behind us. India has underperformed global markets this year, and from Citi to a BofA ML to a Morgan Stanley, brokerages are now coming out and officially endorsing that India is no longer a sell on rise market. It is a market where you want to start participating, and valuations are no longer that stretched. They could be reaching not the value zone but the fair zone very soon. So from an India standpoint, I would say a short-term outperformance stroke or short-term rebound cannot be ruled out, and that is what I think SGX is also indicating. So let's see how markets open, but I think I would be more optimistic than more pessimistic, considering what the market setup is. Jahangir Aziz is ready. Let's connect with him. Yeah, he's ready. Jahangir Aziz, Managing Director and Head of Emerging Market Economies with JP Morgan Research, joins us. Jahangir, good morning. Thank you for joining us.
Morning.
Can I say that the Fed event last evening was more like a no event? It's time to move on. You should go to sleep and we should start a brand new day.
We shall see what the next non-farm payroll number looks like. I think, and what the next inflation print looked like. Look, I mean, the Fed was almost entirely in line with expectations. The separation principle between monetary policy directed towards inflation and other tools directed towards banking sector liquidity support, that was clarified. The fact that they did not change the dots for 2023 was essentially a balancing between the very much stronger data that has come out so far this year versus the likely credit crunch that we will be seeing going forward because of the banking sector stress. I think that the language that they use to say that instead of ongoing increases, they're going to move to some additional increases suggests that probably there's one more hike left. At least that's what we believe, that there is another 25 basis points hike in June, and that's about it for the time being. Having said that, I think ultimately it will depend upon how the US economy delivers in the next few months. And that's where the concern will be. Is the banking stress sufficient to slow down credit, to bring down the labor market and bring down growth to a sustainable point that will hint towards getting inflation down to more comfortable levels or not? The jury is out. Let's see how that rolls out. That works out.
As well, Director of Research at EPFR Global, joins us on the show. Cameron, while it may have been a vote of confidence this time around and on expected lines with what the Fed delivered, do you think that the fact that inflation continues to linger as one of the main issues is what kept the markets from, loading the move further?
The markets here having sort of prodded the Fed into recognizing that inflation was an issue, have sort of turned round and really now seem to be discounting it again, except in a good news is bad and vice versa way. So, from a fund flow perspective, what we've been seeing is actually, some rapidly developing pockets of optimism in the financial sector and technology fund groups.
Jahangir, when the Fed is indicating that they expect the US economy to head towards a soft landing, is it realistic? Yep. Is it realistic with this inflation number and sudden contraction in growth which will happen because of US financial mess? Are we in for soft landing?
So we have I would say about 30-odd% on a soft landing, sort of 50-odd% for a soft landing scenario. Now, that soft landing scenario includes soft landing in the traditional term or a muddled through environment. But there is a concern, and there is that has been sort of something that you and I would be talking about if it wasn't for the banking sector events that happened over the last 2 weeks. That there was a strong sense that 5% wasn't enough, or something even close to 6 wasn't going to be enough, and that the economy required much stronger rate hikes to bring about sufficient slowdown into the economy. Now, the probability of that has gone down simply because the banking sector stress is now saying that the credit crunch that will happen because of the banking sector stress will do some of the heavy lifting for the Fed, and therefore the Fed does not need to go down that route. But that probability is still around 30% as far as we can assess. So I think, it isn't out of the woods. As I said that, we would really like to see whether the credit slowdown is caused because, consumers and corporates loan demand is going down. That doesn't seem to be the case so far. So let's see whether the supply side problems, which is essentially that the lending standards will be tightened from here onwards, delivers that. But we have to keep in mind that all of these things, whether you're talking about monetary policy or whether you're talking about banking sector credit, all of them have significant lags with which it hits the economy. So I would say that, the probability that, you don't need to tighten monetary policy may have gone down, but it's still material.
Cameron, I mean, given that you've got the rate trajectory following the economic data points at one hand, and the other, of course, is, the sort of banking crisis, if you will, which has been evaded. And you had Janet Yellen say yesterday that there was no bailout for owners or investors in any failed US banks. Just wanted to understand that, we're pretty much taking it a day as it comes when it comes to global markets. Which way do you think funds are going to move?
I think one of the things that has struck me in the past couple of weeks is the speed with which a fairly large part of the investor base that we track concluded that the regulators in the US and Europe would not let the banking crisis develop. And I think that's sort of taken hold on a broader level. You were just discussing whether we'll have a hard landing here. It could be possible, but I think a lot of people now really believe that both the monetary and the fiscal policymakers here will do everything they can to avoid it.
Jahangir, Cameron, gentlemen, really appreciate your time. And thank you for joining us. Now, as we walk into trade this morning, what are we working with? We are working with SGX, which is marginal. It is down, but marginally up from the low. Still about an hour left. But Asian markets, by and large, now that the event is behind us, you know directionally which way interest rates are going to move. You know directionally which way markets are thinking. That would argue, you would argue and say that now there could be a case for growth stocks to make a comeback. You can argue and say that emerging market equities will make a comeback. You can argue and say that defensives or expensive P stocks, where interest rates, if they go lower, they will see a re-rating. That entire pocket will start seeing outperformance. I doubt that IT will come back anytime very soon. Typically, just to bring this point for our viewers, interest rates, they act like gravity, which means if interest rates, they go higher, the underlying terminal value of a stock price will go lower. When the reverse happens, high growth stocks and high PE stocks, they will always tend to outperform when interest rates, they go lower. So that explains why post-COVID, immediately growth stocks did very well. And in the last 1 year, when interest rates have gone higher, value stocks have done well. Are we nearing that turn, both locally and globally, where interest rates, if they are peaking out, which they would, and if we get a clear sense from Reserve Bank of India in April, then are we at that turn where interest rates will peak out and growth stocks will make a comeback and value stocks will go on a backseat? Let's see. But I think that could be a trade for next couple of quarters, I think.
Okay, that's the trade setup this morning. Looking at the SGX Nifty, it seems like once again it's going to be one of those quiet days, although it's recovered from where it started off in trade, about 0.3% of a recovery coming in. But last evening, the award ceremony for Padma Awards as well for this year took place at the Rashtrapati Bhavan in New Delhi. And a short while ago, this is one of, remember, the highest civilian awards of the country and are awarded in 3 categories. That's Padma Vibhushan, Padma Bhushan and Padma Shri. Industrialist K.M. Birla, the chairman of Aditya Birla Group, was awarded the Padma Bhushan. Sudha Murthy was among those conferred the Padma Bhushan, whereas late ace investor Rakesh Jhunjhunwala was awarded the Padma Shri posthumously. His wife Rekha Jhunjhunwala and the family were present to receive the award. A total of 106 awards were conferred to people from different walks of life. This is probably the first time that an investor has been honored for reposing his faith in Indian equity markets.
All right, there you go. I mean, it's the first time that a stock market investor has been honored the Padma Shri. It's also an endorsement by the government that the government and the administration is now honoring and awarding wealth creators. Wealth creators who've believed in India.
I couldn't find that person in your contacts.
Wealth creators who've made the impossible look easy. Rakesh Jhunjhunwala was the original folk hero of Indian stock markets. Rakesh Jhunjhunwala was someone who really changed the rules of how an investor stroke trader, by doing something very simple, can make the impossible look easy. So that's his family, his nephew, his son, his brother-in-law. And for the first time, an investor in India has been given the honor of this grand award.
Time to focus in on the markets, levels, technicals, and stock recommendations. We've got Canal Bothra as well as Naresh Mirani joining in for just that. 17,151, that's where we wrapped up yesterday's trading day. Kunal, give us a sense as to what you made of the texture of the market. Given that now the big event is out of the way, we haven't seen any sort of a relief rally or any sort of a decisive move on Wall Street. What does that mean for us?
Good morning, Avan. So I would believe that last 3 days of price action for our markets indicate that we've established a good base at the 16,800 mark on a temporary basis. Now over the near term, there were a lot of resistances at the 17,150, 200 levels, and the index is taking a bit of a pause at those zone. Now yesterday's data was very intriguing, and I have flagged off in the closing segment as well that the 40,000 strike for the Bank Nifty is acting as a major hub for call writers, and when that happens, the index takes a pause. Today is the weekly expiry, so I would expect the index, Bank Nifty specifically, to remain sub the 40,000 levels. So 39,500 to 40,000 could be a broad range for the Bank Nifty, and possibly 17,000 or 17,150 as a broad range for the index. So I don't expect a major gash of volatility for the indices, neither a major correction nor a strong uptick for the indices, but more of a range bound action, and that's where I think it's going to be more stock specific.
Naresh, hi morning. Is that your sense as well? A ranged index and more stock specific a day?
Actually, exactly the same words I would like to have spoken. So the more important point is that the event is over, and that makes it easier to trade, that there is no overnight gap up, gap down risk. So stock specific, it becomes a good focus right now. And clearly the Nifty has indicated that 16,800 is currently a support. 17,200 is the price point which we wait for a sustained move above that, and then we go towards a target price of 17,600. But that is the broader range, 16,800 to 17,600. And stock specific, even in the correction in this sideways period, a lot of stocks have been firming up well for a move. So would be looking out for stock specific longs and focusing on new leadership coming up going forward.
Right, okay, let's talk stocks then, considering both our chartists believe that it's going to be a stock-specific day. Naresh, what's on your recommendation list?
So continue to stick with first a buy on L&T, Larsen & Toubro. The stock is on verge of a triangle breakout. Yesterday also it tried to do that breakout move about 2200, 2220, closed back into the same price. But clearly a stock which is in leadership mode. If you look at the whole capital goods space, ABB, Siemens have continued to make new all-time highs. L&T is setting up for a new all-time high move, expecting a move towards 2,500, a stop loss at 2,140. Second is a buy on Aditya Birla Capital. The stock has been showing strength over the last 3 sessions, even in the weak market, and has made a strong base around 145 to 140 in the near term. Good momentum seen. I would expect this momentum to continue towards 170, a stop loss at 150.
All right, Kunal, let's get in your top strategies going as well. What is it that you're betting on?
So 2 buy calls. The first one is Ultratech Cement, a stock which I've been bullish on earlier, would continue to be bullish on the stock. Targets remain the same at 7,500 for a very short-term trader, and stop loss could be kept at 7,330. The second is a buy on IDFC Limited. Again, I think the stock is heading towards a breakout of a mild consolidation, trading above the 200-day moving average, marginally below the 50 DMA. Would expect a breakout of the 50 DMA as well. So buy with a target of 86, stop loss at 78.
Okay, we're going to take a very quick break on that note. When we come back, of course, we'll discuss all about the stocks that you need to keep on your radar this Thursday morning. But here's ace investor Mark Mobius saying that he would like to invest more in India and sees India emerging as an option for manufacturing semiconductors. He's pretty bullish on India for the long haul as well, and adds that stocks with low debt will do well in equities.
We're looking to increase as we go forward, but right now we've kept it the same as we've had. So we still have a very positive outlook for India. If you look at the Indian market from a longer term perspective, the potential is incredible. I'm not too concerned about these short-term moves. The market could go down 10, 15%, even 20%. That really doesn't concern me. In fact, it could be an opportunity to buy more. So It really depends on what stocks you're holding. If you're holding stocks with very little debt, with good return on capital, then you should do fine, regardless of what happens to the market. This year, next year, 5 years, the Indian market will continue to do well. There'll be corrections along the way, of course, but at the end of the day, those who are in the Indian market in good stocks, in stocks with low debt, they should do fine.
That's the lineup for you today. But in the meantime, let's also find out which are the stocks that are making the news. You will be watching out for Indigo as the company has issued their first ever analyst meet today in Gurugram. So what is going to be some of the key focus points that analysts will really be watching out for? My colleague Somit joins in with all those details. Somit?
Well, it's the first ever physical analyst meet of Indigo and it will be held today in Gurugram. The timings are, it will expected to start at 10 a.m. and expected to end by around 3 p.m. And the location where they are doing this is the iFly Academy, which is a training institute in Gurugram. Now, what the street would want to know from this first ever physical analyst meet of Indigo, firstly is their international strategy. Now, currently the company has gotten some planes and wet lease, but will that be, is that an interim solution or will that be a permanent solution given the slower deliveries of aircraft that the company has been seeing? So that is what one thing that the street would want to know. Along with this, will the company also offer premium economy and business class segments in the international routes like some of its competitors are doing in future, is also something that the street would want to know. On the capacity addition, what is the schedule that they have planned for the next 2 years, 5 years and 10 years, and what is the kind of passenger growth that they're expecting on both domestic and the international front, and what will be the capacity mix when it comes to the domestic and the international front are some things that the street would want to know and want to have some clarity on this front. Owing to the grounded planes and the supply chain issues globally, if you see, we had seen slower deliveries coming in for Indigo. So is that issue resolved or not is also something that the street would want to know, because this is important as newer planes come in, the older planes will go out and that will lead to more cost savings for Indigo. When it comes to the cargo business, there was a boom that we had seen during COVID and the company had also announced many plans back then, but what is the strategy right now given that of late we are seeing some slowdown in the cargo business is also something that the street would want to know from this analyst meet. And lastly, because of the recent correction in the crude prices, some impact of the high fuel cost has been mitigated for the next financial year and there's a strong tailwind. But is the industry able to retain the benefit of this fall in ATF prices, or are the yields are also falling? Now, last quarter the company reported its highest ever yield, but is that sustainable is the key question that needs to be answered in this first ever physical meeting of Indigo.
Right, and Samit, Gail has increased its integrated tariff. Tell us all about that.
Well, if you see, because PNGRB has increased the integrated tariff rates to around 58.61, Gail has said that their revenues could now be higher by around 1800 to 2000 crore based on the current volumes. However, do remember that the tariff is lower than what the company had asked for, and the major reason behind this lower tariff approval is the fact that the PNGRB has assumed that the gas cost would be lower going ahead. Now, PNGRB has considered gas prices to be around $3.6 per MMBTU, which is much lower than what Gail has incurring currently. In fact, the prices are lower than the Kirit Parikh recommended floor price of around $4 per MMBTU. However, the company is saying that once there is clarity coming in from the Kirit Parikh committee report, the company might file a review for this tariff revision, and they are also saying that such review will not take much time and will be taken up by the PNGRB immediately. Now, moving on from this integrated tariff, Gail has also said in their analyst meet that they are expecting the transmission volumes to go up to 120 MMSCMD in FY24, and this is expected to improve by around 5% per annum going forward, and the demand will be driven by fertilizer, city gas distribution companies and refineries. And they also said that with every increase of 1 MMSCMD of gas volume, their annual revenue goes up by around 84 crore. Now, first time the company has also given a clear guidance that they are expecting their gas marketing EBITDA to stand at around 3,500 crore rupees in FY24, and this is a sustainable EBITDA run rate according to the company. And lastly, when it comes to the petrochemical division, which has reported losses to the tune of around 660 crore rupees in the first 9 months of FY23, has finally turned profitable or is at least near break-even given the current low LNG prices and the petrochemical prices. So the company is positive on the petrochemical business segment also.
All right, let's get a move on then and find out what Nilesh Shah's view is when it comes to PB Fintech and why he likes the stock.
Nilesh, now let's look at Policy Bazaar. He was part of a show called Class of 21, and he's gone on record to say that, look, I'm aiming at a profit of 1,000 crore by 2027, official public information. Which means if I look at the current market price divided by the guidance what the management has given, we are looking at a stock trading at about 40-50 times, about 50 times FY27. So growth is great, but the markets are making the stock trade at 50 times FY27. So where is the margin of safety for you?
I think Policy Bazaar, if you really look at it today, the market cap would be, I think, about 25 to 30,000 crores. Okay. So if I were to look at FY27 and the guidance which the company has dished out of 1,000 crores PAT, it's trading at 25-27 times FY27 kind of earnings. Now there are two things. One is that the end of the journey? Answer is no. I clearly believe that that's probably only the first milestone which a company like that has in a marathon which could last for several decades. So my view is that that could just be the start, number one. Number two is, my view is 1,000 crore PAT in FY27 is to me a base case scenario. I probably think that they might achieve that maybe even a year earlier, or they could exceed the 1,000 crore number by FY27 too. Third is, in this market cap, they have about 5,000 crores of cash. Okay. So if you kind of look at it from an enterprise value perspective, strip off the cash, then it's even more attractive.
Yes.
And my view is that
they may start giving dividends, they may start
doing dividends, buybacks, all of that. They have clearly stated that they are not the ones who will go out and buy businesses so far. They prefer to build business rather than buy business, and I like that as an attribute. I see that as a virtue of a management quality, that you're willing to build a business. In addition to that, we always look at PB Fintech from just an insurance point of view, which is rightly so. Majority of the value today comes from insurance. But there is the credit business. I mean, that's a 100 lakh crore market, okay, which they can probably try and address. In addition to that, they have got in principle approvals to start the account aggregator business. That itself, according to me, is a game changer in India's journey of financialization. They have got approval for being a payment license or a payment aggregator. So they have a few optionalities of which today we don't know. Today, it's just looked upon as an insurance company.
Distributor, actually.
A distributor of insurance. Then you have the distributor of credit. And then you have these 2-3 optionalities on which we may get a better color only sometime in the later part of this decade, which can be the growth drivers probably for the next decade.
So you buying Policy Bazaar not because it's BFSI space, but it is a play on tech and growth.
Yeah, I mean, first of all, it's a play on demographics. I think
it's a consumer bet.
Absolutely.
It is not IT or it is not a bet on BFSI space.
Absolutely.
And Jefferies has released a brokerage note on Indian Bank stating that it sees a 20% CAGR in loans over the next 3 to 5 years. It believes that the bank will deliver a healthy growth despite short extensions. So let's take a look at what else was in the note, and Harsh is here to give us the takeaways. Harsh?
Well, yes, good morning. So you've seen Jefferies meet, or rather Indian Bank meet with several investors for roadshows, Jefferies being one of them. Now, the CEO acknowledged that the 2-year extension was slightly lower than the 3-year anticipation that both markets as well as they anticipated. But they believe that doesn't hamper growth going forward. They're expecting a 20% CAGR in terms of their loan growth over the next 3 to 5 years, and that they believe will continue to hold. So that story does not change. They believe that, or they want to continue to build on their domain specialization to ramp up the liabilities as well as loans on both sides of the balance sheet. They've suggested that they will continue to focus on business owner clients, non-residents, home markets and wealth products and relationships going forward, which will continue to add value for the bank. They will ramp up segments like housing, used car, merchant financing, gold loans and business banking while maintaining asset quality, and the current asset quality they're quite comfortable with, they're quite confident about. They continue to reiterate that. Lastly, they've withdrawn from lending to promoter and holdcos, and they've been cautious about lending with regard to micro loans as well. So a couple of those things they've either stopped or are cautious on, which could aid in terms of the numbers as well as in terms of asset quality going forward as well. So a little bit of confidence with regard to some of the commentary coming through from Indian.
Thanks very much for giving us that heads up. Let's connect with Chakri Lokpriya as well, who's joining in on the show on the fundamentals. Chakri, let's get in your take then first up as to how you believe, you're expecting the overall financial sector to pan out in today's trading session. You just heard out my colleague as well, Harsh, talking about the outlook for Indian Bank, that brokerages seem to be fairly positive, but they are a little bit cautious when it comes to micro loans. What's the sense that you're getting?
With yesterday's Fed hike of 25 basis points and saying that, they'll continue to watch inflation. So, and with the banking damage that has happened, it's kind of, so which means the Fed has actually increased rates. This 25 plus another 25 is already kind of reflected in the bond yields. Now, bond yields falling by about 140 basis points is important for the Indian banking sector because, that's very important in terms of how the cost of funds will work out. And so I think clearly as the credit growth is likely to slow down for the Indian banking sector as a result, and valuations are on its side. So I think from that perspective, I think Indian Bank, while looks okay, I think still I'll stay away from it. There are several other banks, including PSP banks, which are looking at that.
Fair enough. There are a lot more banks. So which are those, Chakri, that you can identify for our viewers? Mid-cap, small-cap, large-cap?
I think at some point now, whether it's Bank of India, Canara Bank, State Bank, the State Bank of India among the large ones, I think all these look attractive because now kind of the mark-to-market losses that will ensue because of the yesterday's hike plus what has happened thus far will be crystallized in the coming quarter. So once that is out of the way, I think the valuations are pretty much on their side, but it's a moving target because it's very clear that it's US is not peaked, but close to the peak is probably another 25 basis points. So which means Indian RBI will also hike interest rates by 25 basis points, and that will have a bearing on the cost of deposits of Indian banks, which is what their lending rate is.
Right. Reliance Consumer, by the way, has launched a range of personal as well as home care products. Chakri, what does this really mean for the sector and for Unilever as a competition?
Indeed, it is competition and it is low margins. The industry has been kind of battling with in the last 2-3 years with lack of pricing power, and they've been largely trying to push through volumes. And I think that trend will continue. And Reliance, when it does something, it does it well and does it with a reach. And with and that will clearly impact margins at the outset. And so it's going to be a volume game. So which means over time, we'll have to assign slightly lower multiples to the levers and the Nestle's of the.
In fact, HAL is the other one which is going to be in focus. Remember, the government has launched an offer for sale. They're looking to sell maximum of 3.5% stake at a floor price of 24.50. So that's another stock which is going to be in focus as well. Hero MotoCorp too, they're looking to hike prices of select motorcycles and scooters by about 2% or so. Chakri, your take on the entire auto space, because while there are price hikes being undertaken in various categories, there are also reports coming in that this time around, the pre-festive season sales are not looking all that robust.
Now, if you look back pre-pandemic volumes to now, and compare it to the volumes post-pandemic, i.e. at least from 22 onwards, volumes were down about 40% and volumes have recovered about 20%. So which means still there is leeway, runway. So then for a volume growth to happen. Then there is the cost of buying a bike or cost of buying a vehicle, which has gone up by 200 basis points, 2% in the last 1 year because of RBI's increase rates. So which means this will lower the volume trajectory because the peak was expected sometime now. Now it looks like it's at least another 25 basis points more. So valuations have corrected meanwhile. EVs are now 5-6% of sales, so that will provide some kind of backstop. So in that context, a TVS Motor better placed versus a Hero Motor, and for instance, Eicher Motor better placed than a Hero Motor because they're at the higher end of the scale.
All right, let's move right on then to the mid-cap IT space. And EClerks held their management meet and they told MK that they are expecting muted growth in the near term. What else did they have to say? What have been some of the key takeaways from EClerks? Let's find out from Anisha, who tracks the sector closely and joins in with the updates. Anisha?
Well, yes, so the MK brokerage met the CFO at EClerks, and there is this increased realization coming in from the IT companies, and at least they're accepting it on record that there is a bit of slowdown which is happening, especially when it comes to the deal making. So this is what EClerks management also told them, that deal making has slowed down. They're only seeing partial deal renewals. There haven't been any deal cancellations per such, but definitely there is a big slowdown when it comes to deal conversions as well. The budget cut is something that they're seeing in a couple of clients, so that is also an acknowledgement coming in from these managements now. They remain watchful of the macro condition and expect a muted growth in the near term. However, they are hopeful that in the second half of the calendar year, there might be a bit of an uptick. So at least the near-term challenges continue to persist. They do not have a direct exposure to the troubled bank in the US, but obviously with respect to the systemic risk coming out, that remains a key monitorable for the companies going forward. Separately, as far as their guidance is concerned, they expect that the EBITDA margin for the entire year is going to be towards the lower end of their guided range. They're expecting it to be closer to 28% versus 32%. However, having said all of that, MK still has a buy call on the counter. They have a target price that suggests an upside of around 21% from the current level, because they believe that the medium-term outlook continues to be quite strong, and valuation-wise also the stock is trading at reasonable valuations. The company is also trying to tap into acquisition at this point of time to make use of the downturn, but let's see how it pans out. For now, near-term negative coming in for EClerks.
Chakri, wondering whether it's time yet to buy into IT?
Well, if you look at Indian IT companies, they have roughly about 25-30% exposure to the financial services sector, the banks in the US. And while they have a smaller exposure, so overall that is, and probably about 5% exposure to European banks. So clearly it is going to be a dampener in the short term, i.e., and there is going to be a bound back, a holdback of by the banks in giving out contracts. But as we've seen in the past, that because productivity enhancements are very important, these are very short-lived events. So maybe in the next quarter or two, there'll be a couple of percentage earnings downgrade, but overall those earnings will come back because of these productivity enhancements, tech enhancements will help the Indian IT services sector.
Let's move right on then and run you through the stocks that are on the editor's radar in today's trading session. Let's begin then with Interglobe Aviation. Well, that's going to be an interesting one, Nikunj, because the company is coming out with their first ever analyst meet in person. And I think there's going to be lots of question marks that investors would like to know. What do you think would be top of mind?
New CEO and the sector dynamics are changing. Whether it's Tata's taking over Air India and Vistara and Air India merging, a lot is actually changing for the industry per se. The high growth in this sector continues. Indigo is still maintaining a commanding market share. Go Air has lost market share. SpiceJet has also lost market share. There is a complete erosion in terms of the brand value of SpiceJet also after the after the challenges they had, after the incidents and the challenges they had. Interestingly, Indigo is now going global. They're expanding their fleet. Their order, the kind of aircrafts what they've ordered, that is at a record number. So one side you put the Tatas which are coming in, but second side Indigo has also rediscovered their mojo. For the quarter gone by, their profit was at a record high. I think I've already spelled out 10 things. So why the stock becomes an interesting one to watch today. 10 factors, another 10 more in terms of the ratios, crude coming down. So it's an interesting sector, interesting time. And analysts are expecting that typically when management, they come out and speak, meet in person. When it's more than chai pe charcha.
The first time ever.
It's more than chai pe charcha. It really has to be some strong, indication coming about the company's growth.
A very exhaustive list. That's what we're expecting from Interglobe Aviation or Indigo. Let's move on then. Defense and track HAL in particular. As we told you earlier as well, the government is looking to sell their 3.5% stake in HAL. This is via the OFS route, and this is, as per the probability of MSCI inclusion as well, the inflows could go up for HAL.
Why is Government of India selling? The first thing you would ask yourself. The indication from government was that they will not be selling or reducing their ownership in government companies via the OFS route, or for that matter via the ETF route. So are they likely to revisit that whole sequence of events where whenever they wanted to meet their disinvestment target, if the stock went higher, government would open up their kitty and start reducing their stake? If this isn't one-off, largely got to do with a near-term balancing of disinvestment target, then markets would move on. But if this is going to be a trend in making where apart from HAL, more and more government companies would be there, where the Government of India would be looking at selling their stake, then the markets in the near term will be worried about the demand-supply equation. It's a fantastic business. The sector is in a bull run. So the issue will sail through, but the problem is that these are some of the stocks where government ownership is high. And we've seen that in case of coal and NTPC, when government was selling their stake via OFS and via ETF route, those stocks never did well.
Okay, so we'll have to wait and watch for HAL if it receives the same fate. With that, it's back to you, Aisha. Let's find out what our guests are picking out.
Oh yeah, absolutely. Here's Hemang Jani telling us why he likes IHCL as well as APL Apollo.
We have been liking some of the footwear stocks. So Metro Brands has been something that we've been liking. APL Apollo tubes, we've been liking for a long time. The stock has not corrected as much, but the numbers and the overall growth outlook is looking very strong. I think Indian Hotel is one stock that we've been liking for a long time. The outlook for next year on a higher base continues to look good. So we think that there is definitely going to be interesting pockets to look at when the markets have corrected. And you see some base formation. So surely we are looking at selectively buying into these names.
In case of Cipla and Sun Pharma in particular, I find that the portfolio of products that they have, they are relatively, I think, more stable. Probably despite of all these inspections, and I think hopefully they come around with, I think, the clarity on these inspections. I would rather like to believe that I think product portfolio remains absolutely strong proposition. And there exactly the margins are also, I think, relatively stronger compared to many other generic players, because they are basically into the complex generic specialty generic products. So from that perspective, I like both these companies from investment and would like to believe that, yes, I think they would have probably the ability to answer those US FDA inspection queries, and probably I think they will turn around. So yes, currently the stock price has corrected. Maybe I think the fall continues due to negative sentiments. Maybe one can add the stock into the portfolio in subsequent fall.
All right, let's put the spotlight on Nasara Technologies as well. Their subsidiary Sportskeeda has acquired about 73% stake of Pro Football Network. This is for $1.8 million in cash. Joining in right now is Nitish Mitterson, the founder and CEO at Nasara Technologies. Nitish, good to have you on board. So what's the rationale for this acquisition? Why the NFL? Why focus on the US markets?
Sure. So for us, Sportskeeda has done extremely well since the time we acquired it, and has grown, to almost 80 million monthly users, with a significant portion coming from the US. Sportskeeda is very popular in US and India for esports content, cricket content, as well as content now around many of the US sports, including NFL. And the whole idea is that, we will go deeper with specialized destinations that kind of create more depth of the content and products offering in each of these verticals. So with Pro Football Network, we found a top 3 NFL destination in the US, already has a very loyal monthly active user base of 5 million users every month. And we believe that there's a lot of synergies that we can find between Sportskeeda's operations and this particular site to grow the revenues as well as the profitability of both businesses. So that was the logic. Sportskeeda has been a very profitable business for us, over 30% EBITDA margins, generating strong cash flows. And we are redeploying the cash that has been accumulating in such, acquisitions to create faster and long-term compounding of value for us.
Okay, fair enough. You did talk about what it brings to the table for the company. So just run us through then the kind of revenue accretion that you're expecting over the next few years, given that you're already sitting at 30% EBITDA margins for Sportskeeda. Where can that scale up to?
So, for us, this particular acquisition, this company is generated, in the calendar year 22, about 17.5, 18 crores of revenue. We believe with the addition of the synergies with Sportskeeda, this revenue should at least grow by 30-40% in the current calendar year. And as these synergies play out, we should see faster acceleration of growth for Pro Football Network into the next year. So I think we will continue to run this as a very profitable business. There are synergies in cost levels as well as, revenue increase. So I think overall it will be very positive for Sportskeeda and a great step forward for the company because we are now starting to grow that business through M&A as well, which is something Nasara has had expertise in, has had a lot of success in the last few years, and we are looking to replicate this across the various businesses we operate.
Fair enough. So just to drag that point forward, given that the company has always scaled the 5 verticals, there's been a lot of organic growth, a lot of M&A that we've seen. What else is on the cards? When can we hear about the next acquisition?
I think this timing is very good. Nasara sits today with over 600 crores of, cash reserves, and with the negative, or I would say the, poor market sentiments generally worldwide, we have attractive businesses available to us at great valuations. Even this particular acquisition that we have done is on less than one-time revenue. So I think we will continue to aggressively look at M&A opportunities. There are many discussions ongoing at the Nasara level for various businesses in India and outside. And we hope to use this market situation to our advantage. We will keep you posted.
We'll be in touch for just that. Thanks so much, Nitish, for joining in and giving us that heads up on the latest acquisition. Let's get right back to our discussion with our guests then. And Chakri, curious as to whether or not you have, any of these sort of niche plays, maybe within the gaming space. Of course, there's not much of an option, but say select counters within the hospitality sector that have their niches. Is this something that you would look at as a business proposition or as a stock investment idea?
Well, as a hospitality as a space, we're just sticking to hotels. That's an easy way to do it. And the valuations are on their side, whether it is a Thomas Cook, because it has exposure to multiple segments, right? From sterling holidays to foreign exchange exposure, to Chalet Hotels, which is a combination of both premium hotels as well as some event spaces, and as well as Indian Hotels, which is the Taj brand of hotels, and they have hotels across the price points, right from Taj down to the lower price points hotels. So I think that is an easier way, and also with G20, I think there is a positive momentum in terms, and summer coming, it's fairly positive momentum for the hospitality space through hotels.
Naresh, couple of stocks which saw solid price action yesterday, and the one which really pops up again is Paytm. Where is Paytm headed now, Naresh?
So overall, it is starting to make a base. So if you look at the price action, yesterday was good, but if you look at the action for the last 1 year, say last March around this time, it was around 550 levels to 600 levels. Today we are back to 550, 600. In between, the stock had gone to almost 430, 450 zones. And also there was a spike up to 850 in the year. So a strong 1 year consolidation done. Initially, there was a pull up. Recently also we saw this pull up from 550 to 700, 750 levels, and we've retested 550. So it's very clear that we are starting to make a base at 530, 550. And the stock charts have started becoming constructive. So out here, I would expect a move towards 750 in the short term, short to medium term. Dip to 600, 610 anytime would also be a position to add. A buy at current levels. Good volumes also picking up. So positive on Paytm with a stop loss at 550.
Okay. Kunal, yes or no for Paytm?
Yeah, yes, double yes for Paytm. I would believe.
When or 3 yes?
Double yes, 2 yeses.
Yes.
So yeah. So I think I'll be very bullish on Paytm, Nikunj. I would believe that a major bottom is now in place for the stock, and the classical point for the charts in Paytm and that stands out quite dramatically is the rise with the stock had seen from 440 levels. The stock which bottomed out I think in the month of November. It topped out at the 740 mark, and in this last leg of a correction from 740 levels towards 560, which the stock made a low 2 or 3 days back, there was precisely a 61.8% retracement. So it's very rare to see such kind of a strong price action and then a classical retracement which ends at exactly at the 61.8% retracement mark. And now the stock has seen a bounce from those levels, which means that the corrective phase for the stock is over. We should be ideally looking out for a breakout back again at least about that 740 mark for Paytm, which means after yesterday's closing there should be an upside of at least another 120 points on the upside. That's a good 20%.
Chakri, what do you like within this entire urban niche space? There is metro brands, there is campus footwear, some folks are liking Manyavar, some are liking all three, some are liking two, but everybody is liking one out of the three names I mentioned.
Yes, I think Metro Brands is looking good because, in terms of their EBITDA margins, it's far higher, not far higher, compares better versus, let's say, Bata. And they appeal to a slightly higher price point audience versus a Bata. And they're expanding their reach, their footprint, if you will, across. And so these stocks usually do well, again, with the onset of summer. And again, valuations are still kind of not yet there, but I think it's time to start buying the stock.
All right, in the meantime, let's get in a view then on the charts of some individual counters as well that did manage to spike up in yesterday's trading session. And you did have something like a Fine Organics, which had a fairly decent run. EClerks as well was up about 5%. You had JK Tyre along with Alchem Labs. Those were some of the interesting movers in yesterday's trade. Naresh, your views?
So Alchem Labs is something which has not done for anything for a long period of time, but it's sideways. So that's a stock which I've been watching out for some time now. If you look at the last 6 to 8 months, it's been in a very tight range of 3,000 to 3,350. If it can cross about 3,350, that would be a short-term breakout. And say one of the few stocks which has been making a sideways consolidation in this sector. So Alchem Labs out of all the names is the one I would be watching out for.
Okay, Alchem Labs, that's the one that's on Naresh's radar. Meantime, what about the kind of breakdown that we've seen? Kunal, BHEL on the charts, what's it indicating at about 74 rupees, and ABB?
So BHEL, I would still believe that it looks quite stable in terms of the chart patterns because it's risen up quite well from the previous swing lows. So the lows in the month of February and March start was closer to 66, 68 for BHEL. From there, the stock has rallied up more than 15% to I think 76 plus levels. and now it's consolidating between a band of 76 to 73, 74 broadly. So it's still a, I would say, a healthy chart. It's nearing a breakout of the 50-day moving average. So maybe another couple of days where the stock may trade a bit more sideways, but once the breakout gets confirmed, I would believe that a fresh trend could begin for BHEL. ABB, on the other hand, the longer term trends have been very, very strong. So when you look at ABB, Cummins, Siemens, etc., these stocks have done exceptionally well in the last 3 months as well as over the last 1 year specifically. Even after yesterday's downtick for ABB, I would still believe the chart patterns are quite strong. Would look to buy on dips for ABB, maybe closer to 3,250 levels.
Chakri, yesterday CLSA came out with a report on the insurance sector, and from 5 to 25%, they pretty much have upgraded their price target on every insurance stock. Is the tide now turning for the insurance sector per se?
Across insurance companies, they've all underperformed and they're all down based on the pricing pressures as well as competition, regulation changes, and therefore which will bring down the volumes for the business. And all those things are very real. So I think clearly as a positional investment for a trade, I would buy an SBI Life. But I think longer term, I think clearly because with the tinkering of tax rates, tinkering of those price points is clearly a negative for the sector. So yes, for SBI Life, HDFC Life from a positional investment perspective.
Okay, meantime, what about your outlook when it comes, Chakri, to the entire real estate space? For instance, just a few days ago, we were talking about to the management of DLF, concluding some pretty healthy sales in their newest project. And it seems like the traction is visible within the entire space as a whole. Do you have any favorites here?
DLF, I wouldn't extrapolate it because, DLF land was historical cost. And so the profit margins that they will enjoy on this particular project will be very high. And it was a long awaited one, et cetera, et cetera. So so we wouldn't extrapolate it to the rest of the sector. Now, in the last 1 year, because of RBI hike rates, the home loans have gone up from about 6.7% to about 8.7% in a space of 12 months. Now they're likely to go by another 25 basis points in the next 1 month or so. So I think until we hit the peak, and so there will be that price per point, which still caters to the IT professional sector, which will do well, and the super end luxury segment. But so which means it's very maybe Shobha will do decently okay, but I wouldn't really say that this tide has clearly turned in the favor of real estate as a sector.
Meantime, let's hear it out then from Nilesh Shah, what his outlook is of the global bank turmoil. Is there a history of 2008 repeating itself? Let's hear out Envision Capital's Nilesh Shah in conversation with Nikunj.
In the consumer pack, I think outside of FMCG, maybe things like alcoholic beverages, which we have been now liking for a long time.
But why were numbers for United Spirits so bad? If there's so much of commanding market share, the big picture that good or bad times, you will always consume alcohol.
So first is, I think, the industry-related challenges, twofold. One is clearly input prices. There's still kind of challenges there in terms of input prices. Cost of freight, cost of packaging, cost of bottles, cost of raw materials, all of that. Second is, in some of the states have not yet given them price hikes. So these are two industry-related challenges. For United Spirits, which is a stock we own, they have challenges in terms of trying to reorient their portfolio, and they're trying to yet rejig. So that's still work in progress. But I believe that they have kind of traveled a large part of that work in progress journey. And it's quite possible that maybe a couple of quarters later, you start to see the impact of that positively. The company in that space that we like even more is Radico Khaitan.
You've owned it for almost a year now?
We've owned Radico Khaitan now for almost 3 years.
3 years now.
And it's been honestly so far a great journey with Radico. And we still think it's still early days for the entire industry and for a player like Radico Khaitan, which is a challenger to the two big giants in the space.
How come you didn't buy Sola? Only a whiskey, beer, not dwelling on wine?
Nikunj, we are looking at it. Okay. It's IPO'd very recently. Yes. We are still kind of looking at it. We'll probably kind of spend a lot more time, take a more harder look, and then take a call. But the space is interesting. And therefore, Sula also falls on our radar. But, we haven't yet taken a decision. I guess we're still very early in our research process as far as Sula wines.
Okay.
Okay, that's Nilesh Shah from Envision Capital talking about as to why he likes the liquor segment so much and, of course, the overall beverage space as well. Hindustan Aeronautics, that's the one stock that Nikunj as well highlighted, considering the OFS was announced just yesterday. And, just delving a little bit into the MSCI implications, considering the government is looking to sell that 3.5% stake via OFS, which is going to increase its free float. And the MSCI inclusion cutoff price now comes down to 2150 from the earlier 2650 as well. It's been an 87% move that the stock has seen in the last 52 weeks. But Chakri, how is it that you're viewing this news of the OFS? You think near-term pressure on the stock?
Yeah, Hindustan Aeronautics is clearly a good stock despite the run over the last 1 year. This OFS is, I think, it increases the free float, which is a good thing. And I think it's kind of manageable because it's far less than what was anticipated. So it kind of removes that overhang on the stock. So as that percolates through the system, I would clearly buy the stock, but obviously wait until this OFS happens.
Okay. There's a report on Macquarie on Indigo, premium valuation to sustain driven by strong growth outlook. Crude prices are down. Interestingly, if one looks at last 1 month, crude prices have collapsed, but airline stocks have not really gone through the roof. Kunal, it's always this logical comparison, right? Crude goes down, buy Asian Paints. If you missed on buying Asian Paints, doesn't matter, buy Indigo. That's a obvious crude beneficiary. This time the trade is not playing out.
Yeah, very difficult to anticipate why it's not working out, Nikunj. But yes, this trade is not working out. Berger Paints, Asian Paints, these stocks have not seen an uptick. I think if I'm not wrong, these stocks have not even been able to break past about their respective 200 DMAs at a point when crude has fallen very sharply. So it's not just a correction for crude oil from those 130 levels, but the last 1 week, 10 days, the correction has been very steep and sharp for crude. And that has not even resulted into a V-shaped recovery for these stocks. There has been a mild recovery, where we can probably expect that the base is shifted up higher, but then nothing like a V-shaped recovery for these stocks. Even Interglobe Aviation, for example, the stock has actually corrected very sharply from 2,100, I think a month back, to almost 1,800 or 1,888 where the stock closed yesterday. So again, not major in terms of chart patterns, which is correlating with respect to the falling crude oil prices. So difficult to anticipate that whether this trade is actually panning out or not.
We were just talking about Interglobe Aviation, and given that they're going to be conducting their first ever analyst meet as well today, what you saw on your screens, of course, was Macquarie talking about what they believe about Interglobe Aviation. But the meet is going to be in Delhi today, and given that air traffic or load factor numbers have been very strong, and yes, the crude prices as well have been on their side, the overall environment for Interglobe Aviation looks pretty favorable. Chakri, what's your opinion?
Clearly, yes, would buy it for short-term investment. Clearly, crude is on their side, volumes of business is on their side, but the air fares have not really come down as that much, so which means the margin should be better in this coming quarter. So from that perspective, yes, and they're expanding into cargo, they're expanding into other short international routes. So I think all this should help in the medium term, but airlines as a sector have never really invested for the long term. We buy it for a short-term investment and then move on.